nós vamos dar continuidade aqui no TAG Summit 2022. Vamos então agora para o nosso painel de disruptura na gestão dos investimentos. E para ele, nós contaremos com a presença da mediadora Francisca Brasileiro, sócia da TAG Investimentos. E de forma remota, nós teremos o palestrante Robertson, que é Head of Client Portfolio Management da MAN AHL. Sejam muito bem-vindos. Graham, good morning. Thank you for being here with us. Francisca, passo a palavra para você.
Thank you. Good morning. Good morning, Graham. Sorry for the delay. With English spoken, it's not very common. But I'd like to thank you for joining us today and say that I'm really happy to be here. Graham, I'd like to make a really quick introduction about MAN's group, because I always talk when I'm sharing with the client the fund MAN Target Risk that we have in our client's portfolio. And I always like to emphasize that first, MAN Group has more than 200 years experience, so we are not very common with this here. And also it has more than 100 people involved in asset management, most of them technologists, physics, as I am, and so on. And also the fact that they have a chief scientist officer. I always think it's amazing, but I think more than that, it gave us a good idea of how many things have been happening in the world regarding asset management. Yesterday, we have here with us in our head fund panel, Flavio, that's the asset manager from Giant Steps, a quantitative fund. And he mentioned that across the globe, how many things we have been developing and involving when we're talking about quantitative and systematic asset management. And we have so much to learn about it, and I'm really glad to, well, MANs have been the pioneer about it, so we are here today to have a class with Graham, and I'm very excited about it. Thank you again, Graham. The word is with you.
Great. Thank you very much, and thank you everybody for coming today. I feel, having seen the tail end of the previous speaker, that I should say that this is really going to be quite different. Something completely different, as Monty Python might have said. So, yes, I'm here to talk today about how we can improve traditional investments using some of the systematic techniques that we've built up through our time at AHL over the last 30 or so years that we've been trading. In terms of a roadmap, what I wanted to do was, first of all, talk about what I mean by systematic investing. People also call it quantitative. Systematic, I mean the two in the same thing. Then talk a little bit about where it can add value in the asset management process. Also talk about maybe some of the hidden limits, some of the hidden pitfalls that we have with perhaps discretionary managers, particularly in terms of the way that people look at forecasting techniques in discretionary asset management. And then finally, really use all of that to show you some examples of what I actually mean. How can systematic investing really help you and your investment process? So let's kick off on that journey. So first of all, what do I mean by systematic investing? I've put up here just a comparison with discretionary investing. So systematic investing is really all about human beings, researchers, economists, statisticians, researching a strategy, something that may intuitively make sense. And that would happen in the discretionary world as well. You get a fund manager who's got a firm belief that a certain investment style might work. So in a sense, those two components are the same. It's humans researching some kind of fundamental belief in how markets work and how to make money out of it. But really the differences start after that. In the systematic world, those ideas, after they've been researched and tested, are then implemented by a machine, generally by a computer. And the real point of that is that it's done without emotion. Our biases as human beings don't come into it. Whereas with a discretionary investing style, with a hedge fund manager, for example, who's picking strategies, picking macro trades, they're kind of using their knowledge of the market and implementing those, but not by any kind of rules-based technique. They're not implementing those via any kind of computer. And the difference really is how that pans out. The systematic method is back-testable. We can test through how things work in history, whereas the discretionary view isn't. If that portfolio manager leaves, then that's the end of the process. Whereas within the systematic world, there's very little key man risk because the ideas are baked in to a rules-based strategy. And what that leads you to is, for the systematic side, a wide and shallow approach. So you may have hundreds, if not thousands, of potential trades using a fairly simple idea. Whereas with a discretionary manager, they might research an idea in great depth. But of course, because it's implemented by a limited number of humans, it's necessarily not very wide. So that's the key differences. In summary, what systematic investing allows you to do is to capture really small inefficiencies in markets. And that's because you've got a repeatable process, which is implemented by computers, as opposed to the discretionary world where perhaps you might look for that big trade where you can make lots of money via in-depth research. And what systematic investing enables is diversification across lots and lots of different markets. You can apply the same idea in lots of different places if you've coded it up, and enable you to do things which, quite frankly, a human being might get bored with. So repeatable processes which computers who are doing the implementation don't get bored with. But this very last point is important. This is not a black box process. Systematic investors are often very upset when you call this black box. The reality is it's a transparent box. The ideas are researched, and then the ideas are written down and rules-based. And it's the computers that is implementing these ideas in a very non-emotional way, and that's the key difference. So let's go along and have a look at some of those techniques in particular. So I'm going to talk about two systematic techniques today. You may have heard of both of them. One is trend following, and the other one is volatility scaling. We'll start with trend following. It's a strategy that's very, very close to AHL's heart. At AHL, we've been running trend following strategies for around about 30 years now. We started trading those in the late 80s and early 90s. And essentially, trend following is a very, very simple strategy. If you see the price of something going up, it can be anything, and this is looking at the cartoon on the right-hand side. It could be an equity, it could be a bond, it could be a commodity. If you see the price of something going up, you buy it. And if you see the price of something going down, you sell it. So inherently very, very simple. And we test this over time. There's real reasons for expecting trends to exist in markets. So first of all, if we believe our finance or economics 101, in theory, information is supposed to be available or imported into markets immediately. In practice, it may take a while for an investment committee to sit and take into account a new piece of economic information. So information trickles into markets over time rather than being suddenly implemented. Human beings, still the main participants in markets. Human beings get quite emotional. We hate losing money more than we like making money, and that gives you a kind of systematic bias to it. And actually, we have long-term macro cycles too. All of these things give rise to trends. And we've tested that over time, and we believe it works. And we use computers to implement that idea. And we trade it across hundreds of different markets, across equities, FX, etc., etc. And those trends can last anything for a few days to multiple months. And I guess what makes it interesting is that we can profit from markets both going up and down. We're ambivalent to market direction. That's one of the reasons it makes it quite different. So this is theory. Let's have a quick look at an example. So it's initially, I guess, a fairly complicated picture, but let's break it down. So the top chart here is the thick line in the top chart is the price of US 5-year government bonds over the last 5 or so years. You can see in the yellow zone, the price of government bonds, 5-year government bonds, is falling. In the green zone, the uptrend around about 2019, the price of those government bonds is rising. And then you have range-bound markets, April 20 to October 21, marked in red here, where really the price hasn't gone anywhere. And looking down to the middle of the page now, a trend follower's positioning is fairly intuitive. In these yellow zones with downtrends, we're positioned short, taking advantage of prices falling. In the green zone, in 2019 or so, you can see from that middle chart, we're positioned long, so take advantage of the price rising. And then in that range-bound market, which is the painful area for this strategy, 2020, 2021 in red or so, our positioning is mixed, and you tend to kind of bleed money rather than significantly lose it. So in a sense, very simple strategy. When the price is going down, you short it, hopefully it's profitable. When the price is going up, you go long, and when it's range bound, the strategy can bleed a little bit. Now this is one market. As I mentioned, the huge benefit of systematic is that you can repeat that process across hundreds of markets. And in fact, this is what we do. This is a sample market list of the kind of instruments that we trade within trend following. Looking at the left-hand side, our risk allocations are roughly equal across 4 asset classes: stocks in dark blue, bonds in yellow, currencies in light blue, and commodities in green. So roughly the same amount of risk. So well diversified across these 4 asset classes. And we trade this is a sample instrument list on the right-hand side: agriculturals, coffee, cocoa, bonds, globally distributed government bonds. On the FX side, as many crosses as we can: energies, crude oil, Brent crude, gasoline, interest rates, metals, copper, gold, etc. Basically everything that we possibly can. If it's big and it's liquid, we will try and trade it. That's essentially what a trend follower is trying to do. It's been a very lucrative strategy on a year-to-date basis. So here I show returns of multiple asset classes on a year-to-date basis. So stocks and bonds have really struggled this year. So traditional investments, traditional long-only investments have struggled. Hedge funds in the middle on a year-to-date basis, kind of, you know, not too much on the upside, not too much on the downside. But trend following, on the right-hand side, these are 2 indices of trend following managers have done incredibly well. Intuitively, why is this? This is because this year we've seen bonds and stocks going down. That's what the 2 dark lines on the left-hand side show. And you've seen commodities going up almost in a straight line, driven by, of course, that, I would argue, inflation is the main driving factor. So trend following has really benefited this year from that inflation-driven fall in bonds, rise in commodities, fall in equities. So it's very much a strategy that's proved its worth this year. A second technique that we use within systematic investing is what I call volatility scaling. Some of the rationale for volatility scaling comes from this page I have on screen, which is an extract from a paper called The Impact of Volatility Targeting that we wrote in conjunction with Professor Cam Harvey in 2018. And essentially, what it tells is if we progress from left to right here, just looking at US equities, it's a key result from this paper, is that going back 1926 to 2017, so going back about 100 years, what we see on this left-hand chart is that next month's return in equities is really totally unrelated to how volatile equities are this month. So in other words, on that left-hand chart, if we split volatility into quintiles, the lowest volatility on the left-hand side, the highest volatility on the right-hand side, there's no prediction of next month's return from it. You can't get any information about next month's return from volatility. On the other hand, looking at the middle chart, this month's volatility is a very good predictor of volatility next month. In other words, if volatility is low this month, next month volatility is also low. If volatility is high this month, next month's volatility tends to be high. And of course, we equate volatility to risk. So if we combine the two on the chart on the right-hand side, what we see is that our risk-adjusted returns is actually highest when volatility is at its lowest. And that's a really nice conclusion, because what it tells us is that we're actually not paid to take any risk when equities in this case are very volatile. What that means is that we should take off some positions when markets are volatile. And of course, that's really nice, because essentially when markets are volatile, we want to sleep more at night. So it's a nice conclusion that we can sleep well at night by taking off positions and at the same time not risk our returns. And of course, this is all suited to systematic investing, because this is really quite a laborious task. We really should, in this case, be looking at our positions on a daily basis, adjusting them according to market volatility. And that's really quite a painful thing to do for a human being, but it's a very easy thing to do for a systematic process which is implemented by computers. We can show that as a live example on this next page, page 12. So here in gray, we're looking at MSCI World Equities. That's the shaded area from 1995. And you see there very clearly the tech bubble bursting, 1999 to 2003. You see the GFC, the Lehman crash, 2008. And more recently at the right-hand side here, you can see the COVID-related market falls. Now in yellow here, what I show is the volatility of a classic traditional 60-40 portfolio. In other words, a portfolio made up of 60% equities and 40% bonds. And notice that on average, the volatility of that portfolio, of the yellow line, the volatility there is about 10%. 10% annualized risk per year. But notice in particular that your volatility of your traditional portfolio in yellow is very, very high when markets are crashing. So look at 2008, for example, center of the page. Your volatility of this 60-40 portfolio was something like 18%. And similarly, you've got in a period, let's say 2003 to 2007, equities are rising. Your 60-40 portfolio, your volatility, your risk is very, very low. And this is, of course, completely counterintuitive, completely the opposite of what you'd expect. You're running your maximum risk when equities are falling the most, and you're running minimum risk when equities are rising a lot. And that's completely counterintuitive. The blue line, on the other hand, is our volatility scaled portfolio. And you'll notice here that the average is about the same, at 10% volatility annualized, but it's much more consistent over time. In 2008, that blue line is much closer to 10%. In 2003 to 2007, our volatility is much, much higher. So in periods where traditional assets are falling, we've got less risk on the table. And in periods where equities or traditional assets are rising, we've got more risk on the table. So volatility scaling enables you to take advantage of the upside, but also limit your exposure in the downside, and helps you sleep better at night. So those would be, to me, two key areas where trend following, where systematic investing can really add value to a portfolio. And as I mentioned, later on, I will demonstrate that. But I thought it would also be useful to show where traditional discretionary forecasting can lead you into trouble. I was drawn to this wonderful quote by Niels Bohr, who won the Nobel Prize in 1922. He said, "Prediction is very difficult, especially if it's about the future." Yeah. And a nice way of looking at that in our finance world is to look at predictions of the S&P. So, and this is readily available data from Bloomberg that I've used. And essentially what we want to do here is look at the predictions for the S&P by those 12 or so institutions on the right-hand side on an annual basis, look at those predictions and compare that to how the S&P actually ended. Now remember, the S&P is probably one of the most watched barometers in financial assets. And the institutions on the right-hand side are obviously contain some of the best informed analysts out there. So very well-known instrument, very well-informed analysts. Let's see how they get on. So in the beginning of 2017, Bloomberg, or these analysts, all submitted their estimates of the S&P to Bloomberg, and actually they thought that the S&P that year would be up between about 5 and 10%. The S&P that year was actually up just over 20%. Okay, so they underestimated it. Let's fast forward 1 year. The various analysts decided to widen their estimates. They thought that in 2018 the S&P would end up between about 4% up and 13% up. Actually, the S&P was down 7% that year. So here's 2 years where those well-informed analysts on the S&P have really got it completely wrong. And I'm going to skip on ahead here. You can see quite clearly that the analysts have been a little bit shocked by how off they've been. They're widened their estimates, and they still managed to misestimate it. That extends to 2020, 2021, and even 2022. And the key question is, well, should we take an awful lot of time and effort trying to forecast returns when some of the biggest houses, biggest investment banks with the best analysts really failed to do so, even in something like the S&P 500? And it's not just equities. You have a similar situation in fixed income. Here are short-term rates in the US going back to 2000. Apologies for these small labels here, but short-term rates in the US. And we've put little hairs on this. These are what is predicted from short-term rates by the futures markets. In other words, what the smart money out there is saying and betting money on is what is the likely future outcome of short-term rates. And you can see quite clearly here that futures markets really don't predict actual rates very well. Look in particular 2009, 12, 15 or so, that area in the middle of the curve. The predictions from the futures markets were systematically much, much higher than what actually materialized. Again, predictions in financial markets are very, very hard to do. And again, I come back to another quote, this time something that people talk about for Henry Ford. If I'd asked people what they wanted, they would have said faster horses. So our analog here is, well, let's not try and predict better. Let's try a completely different technique. Let's think about risk management. Let's think about a different way of improving our techniques going forward. So let's do that. Let's actually take a case in point here. So we want to look at improving our portfolios using systematic techniques. So let's start with classic 60-40. So the top here is a 60-40 portfolio, 60% allocation to MSCI World Equities, 40% allocation to global bonds, a classic traditional portfolio. This is the account curve going all the way back to 1994, all the way to, I think it's July this year. As the legend shows, this portfolio has a Sharpe ratio, risk-adjusted return of 0.53, a volatility of 8.6%, and an annualized return of 7.2%. So not a bad annualized return, the kind of return that we probably expect to get long term. This is going back 25 years or so. The bottom of the chart in the dashed line is simply the drawdown profile. But these are really quite significant drawdowns. So the drawdown of a really what is arguably a well-diversified portfolio of equities and bonds. If you look at the tech bubble bursting in 2002, there's a drawdown there of 25%. If you look at the Lehman crisis, the GFC, the Great Financial Crash, your drawdown is more like 30%. Actually, as I'm sure we're all aware in the room, this year has been very difficult as well, with a drawdown of around about 15%. So a highly diversified, broad traditional portfolio really does show significant drawdowns over time. Can we do anything about that? What can we do to help it? Well, let's draw on some of these techniques that I've outlined. Let's draw on, first of all, diversification. So remember, the beauty of a systematic process is that we can, once we've established a process, using a computer to implement that process, we can trade tens, if not hundreds, of different markets. So if we take, for example, a portfolio of multi-asset futures markets, let's say on the left-hand side, 25 or so different equity futures markets, a broad-based universe of credit instruments, let's say iTraxx in Europe, CDX in the US. On the bonds and rates side, again, we restrict ourselves to big liquid futures markets and short-term rates, again, around about 20 of those. And we take some kind of inflation basket constructed of commodities and inflation-linked bonds. So here's a broad portfolio of globally distributed different assets, all very big, all very, very liquid. Let's start with that portfolio and just apply our thinking, you know, our various systematic strategies to those. So first of all, using systematic techniques to enable diversification across multiple asset classes. Then we can start to think about some techniques to apply to those 50 or so different instruments. The first of those is that volatility scaling that we've discussed already. So here we have a situation where history, on the various academic papers, tells us that when market volatility is high, we're best off reducing our positions. When market volatility is low, we're best off getting into some more positions. It's good to take advantage of benign markets, but when markets are tough, we should get out of trouble, we should reduce positions. So this is our volatility overlay. We simply volatility scale each of those different markets I mentioned about. The second systematic technique that we can use on this distributed portfolio is a trend overlay. So this is looking to take advantage of AHL's 30 years or so of history in trend following. And all we do here for each of those 50 or so different markets is look for sustained negative price trends. So what our experience in trend following tells us is that if we see the price of something going down, our best guess at what happens next is to reduce the position because we think the price is going to continue to fall. So we're simply using that systematic technique to take some positions off the table when prices are falling, because history shows that that's the best way to preserve your money. And finally, at the bottom here, just one other technique we haven't discussed at this point. We have a correlation overlay. And what that simply does is to try to spot periods when bonds and equities are positively correlated and both are going down. So remember, if we look at history, generally speaking, what you find is that when equities are going down, there's a flight to quality in terms of government bonds, and that's why you put them together in the same portfolio. But of course, the same doesn't happen the opposite way around. If bonds are falling, there's not necessarily a flight to equities. And again, this year is a great case in point. So here's three techniques that are systematic techniques built on implementation across multiple markets, because we can do that using a computer for implementation. And let's have a look to see what kind of effect that has on our portfolio. So consistent with the previous slide, the dark blue is our 60-40 portfolio with a Sharpe in the legend there of 0.53 and a maximum drawdown of 32%. Now this new portfolio, so our systematic version, if you like, incorporating more markets, and these systematic overlays is shown in green. So on the top, we show the account curve. So first of all, you see the improved return profile. So now our annualized return 10.9% rather than systematic, rather than 60/40 7.2. But our risk-adjusted return, our Sharpe ratio, again, this is in the legend at the top. Our new portfolio is Sharpe 0.9 relative to 60/40's 0.53. So you've doubled the risk-adjusted returns by expanding the market set and using some of these systematic overlays. But what I think, having traveled to many locations, resonates most with investors is the improvement in the drawdowns. And again, this is at the bottom of the chart here. And what we find is that our systematic overlays now, the maximum drawdown in each of the three cases that we highlighted is better. Particularly if we look at the maximum drawdown of this new portfolio is something like 19%, which is, significantly less, about a third less than the drawdown of our 60/40 portfolio at 32%. So really what we're seeing so far is adjustments to the traditional processes, building out the market set, building in the systematic process. That can make a significant difference to your traditional portfolio, both in terms of returns and drawdowns. But we're not happy there at AHL. We think there's always something we can do to get better. And let me just step back and explain how we do that. And I'm going to go back to this kind of cartoon diagram again. So here we have the classic profile of a long-only investment. So let's say we're long-only in equities, for example. Here we have just a schematic where we've got equities performance on the x-axis here, on the horizontal axis, and our strategy return of a long-only portfolio on the vertical axis. And it's essentially a straight line. When equities are up, our long-only strategy is up. When equities are down, our long-only strategy is down. So far, so simple. If I add on, however, the profile of a trend following strategy, you can see how things are really quite different. So remember, trend following is all about buying something when the price goes up and selling something when the price goes down. Now, intuitively there, we need trends in markets, and when we see big moves in markets, big trends, now whether that's down on the left-hand side of the chart or up on the right-hand side of the chart, trend following does well, right? So looking at that orange line on the left-hand side and the right-hand side, trend following performs well when we have big market moves. On the other hand, trend following really struggles when markets are range-bound in the middle of the chart. But hopefully some of you can see the advantage of pulling them together so far, right? On the upside, when markets are good, when markets are going up, both strategies are hopefully performing well. But the real benefit of combining these two strategies is going to be on the left-hand side. So as we progress to the left-hand side of this chart, clearly you get the bigger benefit of trend following. So as you progress to the far left, when your equities are falling the most, or whatever asset class you're looking at falling the most, that's where trend following has historically performed well. And that's where adding trend following to a strategy is also likely to benefit most. So you get the best advantage of adding trend following, that systematic strategies, to your long-only portfolio, the worse things get. You can probably see where I'm going with this. So what I'm going to do now is just step again into our case studies. So the dark blue again is our 60/40 portfolio. The green in this case is our long-only portfolio, multi-asset, but with a few systematic techniques. And then I've added the orange line here, which is simply the green line, 75% of our kind of multi-asset systematic portfolio. But this time I'm adding or substituting 25% trend following. So I'm simply taking our existing portfolio in green and substituting 25% trend following. What do we end up with? Well, let's look at the legend at the top of the chart here. So first of all, our 60-40 portfolio had a return of 7.2%. Our added systematic portfolios, systematic overlays in green, that boosted the return to 10.9. And adding trend following improved our return again to 11.2%. Our Sharpe ratio, however, our risk-adjusted return has increased significantly more because our volatility has fallen. So this time our Sharpe ratio, 60-40, 0.53, adding our overlays, turned it into 0.9, and adding or substituting our trend following on top, this time has boosted that to 1.09. So better returns, reduced volatility, and better risk-adjusted returns. But again, let's look at the lower half. Let's look at the drawdown profile. Again, we've got the drawdown profile of our new strategy, if you look at our blend, including trend following in orange. And this time, notice again the significant improvement in the drawdown. In each of our three cases where you see big drawdowns in 60-40 portfolios, we've seen improvements through both our green line, the systematic overlays, and our orange line, the adding more trend following, to the point that the overall drawdown has been actually reduced by a factor of 2. Our 60-40 portfolio had a drawdown of 32% in 2008, whereas our trend following strategy has its biggest drawdown of only minus 15%. So you've halved your drawdown, you've improved your risk-adjusted returns. Conscious of time, let me summarize very briefly what I've been discussing with you today. So systematic techniques enable sort of repeatable and back-testable processes. Traditional ways of predicting returns is actually really hard. And we've seen that through our S&P returns. We've seen that through our futures prices, or what futures prices tells us is going to happen to interest rates. And that's really, so we don't utilize those in systematic tests. It's very hard to systematize forecasts. Instead, what we do is we concentrate on risk management. We try to improve risk-adjusted returns by not trying to forecast returns better, but instead we try and forecast risk better. And that's very much suited to a systematic process. This works in lots of different ways. A couple of examples I showed you. One was in a long-only context. This was the green lines in my case studies, just diversifying across multiple asset classes and using systematic overlays. But also, we can adjust that, and we can say, well, let's enable us to go short. Let's incorporate some trend following strategies, and then we can improve the strategy even more, both in terms of risk-adjusted returns, overall returns, and I'd say most importantly, reduced drawdowns. And in summary, that robust risk management, which is our focus, really can be used, or we've demonstrated that it can be used to really significantly improve your portfolio returns. And all that's done without the use of a crystal ball. We've done that without anybody trying to predict the market. We've used historic analysis to improve our understanding of risk and improve our returns that way. And as I said at the beginning, this is not a black box process. It may be systematic, it may be quantitative, but there's genuine thinking and economic ideas behind it. It's not a black box, it's a transparent box. With that, I'm going to pause and see if you've got any questions for me.
Perfect. Ren, I have plenty of questions here for you, but in consideration to our Britannic time management, thank you a lot for doing the presentation and going straight to the point. And it's every time I see it, I just think how much we have to learn about it, but more important, how much it adds to our local portfolio. So that's the real diversification for us here. I always say that diversification offshore is not exactly investing in the S&P 500, but as we could see in your presentation, there are a universe of strategies that we can use. So I will send you the questions later, and then we can share it to our clients. So thank you again for accepting our invitation. Hope to see you in Brazil someday, and until the next time.
Thank you all. Thank you.
Thank you.